Good afternoon. On behalf of the Federal Tax Section, this is Thomas Treese, Resident Associate at Baird A. Lyle P. LLC, and current phones are. Today's speaker is Collin R. Clark. The topic is New Regs under 707 and 752. Time permitting, a Q&A portion will follow the presentation. To ask a question during Q&A, press pound 6 to unmute yourself. A CLE course code will be emailed out to all registrants following the presentation. Collin, you may proceed when ready.
All right, thank you. Like you said, my name is Collin Clark. I was born and raised in Plant City area, relocated to St. Pete after finishing my LLM in tax at the University of Florida. Prior to law school, I got a bachelor's degree in accounting at the University of South Florida. Formerly, I was a solo practitioner for 2 years and completed over 100 pro bono hours in each of these 2 years at a local LITC program. Recently, I have completed all 4 CPA exams and moved in-house with Accounting Resources and Management Services, which is a full-service tax and accounting firm that caters towards small to mid-sized businesses and high net worth individuals. Today I'm going to go over the new regulations under 707 and 752 that were passed in October of last year. Overview, I'm going to start by reviewing basic partnership provisions dealing with contribution and distributions to get us into the partnership mindset after such a wonderful Thanksgiving break. And then I'm going to go into the disguised sale rules and how they are an exception to the general non-recognition of partnership distributions. And we'll review what the test was for identifying a disguised sale before these new regulations became effective, and the previous rules for allocating liabilities among partners, along with previous rules on bottom dollar guarantees. So a quick overview of the basic partnership mindset that these regulations deal with is generally when a partner contributes assets or an interest in a partnership, it's tax-free under Section 721, both to the partnership and to the contributing partner. The contributing partner would take a substituted basis, so the basis that they had in the contributed property would be the basis that they receive in their interest in the partnership. And the partnership itself takes a carryover basis for whatever the basis was to the partner in the contributed property. The partnership would have the same basis in that property. When it comes to distributions, the recipient partner would generally not have to recognize any gain on a distribution of cash or property unless the value of that property exceeds the recipient's partner's basis in their partnership interest. For any non-liquidating distribution, the recipient partner's basis and its interest of the partnership would then be reduced by the amount of money or the basis of any other partnership property that was distributed to that partner. So disguised sales rules are a general exception to these basic contribution and distributions of partnership assets or property to a partnership. So generally, a partner would be able to contribute appreciated property to a partnership and receive a cash distribution from that partnership up to any basis that the partner had in the contributed property and would not have to recognize any gain. Disguised sale rules of Section 707 and any regulations under 707 would treat certain contributions and some related distributions instead as a taxable sale between the partner and the partnership. So a disguised sale generally occurs if there's a direct or indirect transfer of money or other property by a partner to a partnership. And in addition, there's a related direct or indirect transfer of money or other property by the partnership back to that contributing partner, or maybe even another partner. And those two transfers, when viewed together, can be characterized as a sale or exchange of property. In that case, the transaction will be treated as occurring between parties acting other than in their capacity as members of their partnership, and therefore treated as a sale or exchange and not just a contribution and distribution from a partnership. Disguised sales before the regulation update in October of last year were generally regulated by 707 and the regulations 707-2 through 8. So the tests that were applied for identifying a disguised sale was a facts and circumstances test under 707-3B. And under that test, it would have to be shown that the transfer of money or other consideration going to the partner from the partnership would not have been made except for the fact that the partner had just contributed property to the partnership. And if the transactions don't happen simultaneously, the subsequent transfer was not dependent on any entrepreneurial risks of partnership operations. The regulations went to outline 10 facts and circumstances that may tend to prove the existence of a sale as opposed to just a contribution and distribution to and from the partner in a partnership. There was also a 2-year presumption under 707-3 that said any transfers made within 2 years are automatically presumed to be a sale unless the facts and circumstances clearly establish otherwise. And any transfers outside of those 2 years would automatically be presumed to not be part of a sale unless facts and circumstances clearly established otherwise. Under 707-4, there were certain distributions that would be exempt from disguised sale treatment even if they were made within that 2-year period. Any distribution that represented any reasonable guaranteed payment or a preferred return from the partnership within that 2 years would automatically not be treated as a disguised sale, or if it consisted of operating cash flow, so regular money coming into the partnership based on its operations as opposed to money that had been received as proceeds from a loan or money that had already been sitting within the partnership, or any money that represented reimbursements for any pre-formation capital expenditures, also called CapEx, any expenses that were made towards the property that was contributed to the partnership by the partner could be reimbursed within the 2 years without being reclassified as a disguised sale. So when it comes to liabilities that get contributed to a partnership by a partner for disguised sales purposes, there's qualified liabilities and non-qualified liabilities. Qualified liabilities would generally not give rise to any disguised sale proceeds, and assumption of non-qualified liabilities does give rise to disguised sale proceeds in any amount of the liability that gets allocated to other partners, which is where Section 752 comes into play. The problem can be, even if you have qualified liabilities, is if there's non-qualified liability, or if the partner just receives any amount of disguised sale consideration, a portion of any assumed or shifted qualified liabilities can become what's called tainted and therefore treated as disguised sale proceeds as well. So one of the regulations, 707-5, that made leveraged partnership transaction possible, it said that under this rule, cash proceeds that were traced to a liability that was incurred by a partnership and distributed to a partner within 90 days of incurring that liability can be treated as disguised sale proceeds, but only to the extent that it exceeds the partner's share of that liability. So a partner would go out of their way to be allocated all or a large portion of that liability in order to avoid being taxed on any distribution of the proceeds from that liability. So prior to these regulations, in 2016, partner share of recourse liability was determined, in normal rules under 752, and non-recourse liabilities of the partnership were determined in accordance with any allocation of excess non-recourse deductions, which is the third tier under 752, which we will discuss. So basically, when it comes to just liabilities being shifted within a partnership, a partner can simply guarantee a portion of partnership debt without making any contributions of property or cash, and their allocable share of these partnership liabilities is treated as having been contributed money to the partnership under 752, and any partner whose share of the liability decreases is treated as receiving a distribution from the partnership. So although no cash or property changes hands, the simple reallocation of partnership liabilities can be deemed as a contribution or a distribution under 752. So any partner's basis in a partnership would be increased by either money contributed, property contributed, or a deemed contribution, such as under 752. And any deemed distribution based on a reduction of a partner's allocation of partnership liabilities would decrease that partner's basis in their interest in the partnership. So knowing the allocation of these liabilities under 752 is relevant for determining whether there is a disguised sale in connection with contributing property to the partnership. And even if there isn't a disguised sale issue, it's important in determining the consequences of a deemed contribution or a deemed distribution that results from any shifting of liabilities. So the real key is determining whether a liability is recourse or non-recourse under 752. And the basic rule is that liability is recourse to the extent that any partner bears the economic risk of loss for the liability, and non-recourse to the extent that no partner bears the economic risk of loss. So economic risk of loss has been a term of art. It's just a partner that bears loss for partnership liability if the partner is obligated to make a payment to somebody and would not be entitled to any reimbursement from any other partner or person related to another partner, in the assumption that a deemed liquidation occurs in the partnership and assuming that the assets of the partnership become worthless and all liabilities of the partnership are required to be paid in full. So in order to do this, common ways are to have a partner can have a DRO, a deficit restoration obligation. They can guarantee partnership liabilities. They can pledge some of their own assets up against partnership liabilities, and can sometimes even exist when the partner is the lender themselves. So recourse liabilities get allocated to the person or partner who bears the economic risk for that liability. Non-recourse liabilities, however, are allocated according to three tiers. But these three tiers are no longer used under the new 707 regulations for allocating non-recourse liabilities. So the first tier, that a partner would generally get non-recourse liabilities and any amount of their partnership minimum gain, which is any amount for which a non-recourse liability exceeds the book basis of a piece of property. The second tier, the partner would be allocated non-recourse liabilities equal to that partner's share of built-in gain under 704C, assuming that the property that is subject to the non-recourse liability were sold in just full satisfaction of the liability, but for nothing else. So essentially, it's the value of the liability that exceeds the basis in that property. And then any third tier, the excess non-recourse liabilities, would generally be allocated in accordance with the partner share of partnership profits. However, 752 regulations permitted the widely used alternatives, which instead they could be allocated in accordance with any significant item of the partnership. So 707, the new temporary 707 regulations work to not permit the use of any of these alternative methods for disguised sale purposes. So when it comes to a guarantee of a partner guaranteeing partnership liabilities, a partner would generally want to increase its allocation of as much partnership debt as possible, because in turn, that would reduce the likelihood of a disguised sale for their purposes, and it would increase the likelihood of being able to receive non-taxable distributions from the partnership. And the easiest way to do that was for a partner to just guarantee a portion of partnership liabilities. There were, however, anti-abuse rules, which said under 752, which said that an obligation of a partner to make a payment could be disregarded or treated as an obligation of another person or partner if certain facts and circumstances indicated that a principal purpose of the arrangement was actually to eliminate the partner's economic risk of loss when it came to guaranteeing that debt, or it created the appearance of the partner bearing the economic risk, when in reality, the substance of guaranteeing the debt was otherwise. The obligation of a partner under 752-2 would also not be recognized if the facts and circumstances evidence any sort of plan to circumvent or avoid the obligation. So the Canal Corp case and others, that's where the IRS sought to apply this particular rule before these new final and temporary regulations came out. So the general leverage partnership structure would be when a partner contributes a asset that has very little or no basis, maybe it's already been depreciated down to zero, and fair market value, significant fair market value. They would contribute it. They would get a zero basis or a low basis in their partnership interest. The partnership would then take a loan out on this property, and the contributing partner would guarantee that loan, and therefore that increases their basis under 752 in the partnership, and those loan proceeds could be distributed out to the contributing partner tax-free. That's the simple way of doing it before the change. Another way that a partner could be allocated, other than just guaranteeing debt, was what's called, even more beneficial to the partner, with a bottom dollar guarantee. So that's where a partner would only guarantee debt up to a minimum amount that's not received by the lender. So essentially, if you have a $2,000 loan, a partner could guarantee only a portion of it, $200, as long as at least $200 was paid back on that liability, they would have no other obligation. However, they would get an increase in their basis in the partnership based on the amount of loan that they were guaranteeing. So it was used by partners to make it look like they're bearing economic risk of loss, when in reality they're only guaranteeing the least riskiest portion of the liability. So these are contrasted from other types of guarantees, which is like a first dollar guarantee. So that's any amount of the liability that's not paid can be recovered by the person guaranteeing the liability, and vertical slice guarantees, which is where each percentage of each unrecovered dollar is guaranteed. So if half of the loan is paid back and half of it is not, essentially half of what's still outstanding, if that's what you guaranteed was 50%, would still be liable to the guaranteeing partner. So a simplified bottom dollar guarantee example would be when you have a partner who may have like real estate or property that has a basis of zero and a fair market value, and that's significant, that's subject to a non-recourse liability. They could contribute that property to a partnership. They would get the zero basis in their partnership interest, which is the carryover basis from the property that they contributed. And they would then go on to guarantee a bottom amount of any already outstanding partnership debt. So for the example here, if the partnership had $50,000 in already outstanding debt, they would make a bottom dollar guarantee with that debt. They would get allocated basis based on that bottom dollar guarantee, even though it's the least riskiest portion of the debt. and therefore not have to allocate any gain based on giving up the non-recourse liability. So a brief overview. There was 2014, there were proposed regulations. They had under 752-2 for a liability to be treated as recourse liability to a partner. They had certain rules where all of the following factors had to be met, and those are listed. And under these proposed regulations, the standards would have applied for all purposes and not just for purposes of exceptions to disguised sale treatment, which made it very difficult for a partner because it was an all or nothing test. If you met a majority of the factors, but not all of them, it would not be deemed a recourse liability, even though, the extent to which the economic loss really does fall on a partner, you wouldn't get credit for it. So it made it very difficult for a partner to have recourse liabilities because you had to meet every single one of these factors. In addition to the payment obligation standards, these regulations targeted bottom dollar guarantees under 752-2 and would have required that a partner be liable up to the full amount of the payment obligation if a partnership liability was not satisfied. In addition to this that was called the net value requirement. So in addition to that, it would have recognized payment obligations of a partner only to the extent of the net value of the partner or related person. So if a partner is guaranteeing debt for more than an amount of what their net value was as a partner, they couldn't get credit for guaranteeing that full amount. They could only get credit for what that partner was actually worth. So these portions of the 2014 proposed regulations received a lot of negative comments from tax practitioners, and changes were made in the 2016 regulations that were released. So on October 4th of 2016, the Treasury finally released this package of both proposed temporary and final regulations that modified, changed, and even removed some of the rules that were previously used. So there was final regulations under 707 that involved CapEx expenditures, the de minimis exception that would cause qualified liabilities to become tainted, the step into shoes rules for CapEx and qualified liabilities. They created a new category, qualified liability, and they adjusted the alternative methods for allocating non-recourse liabilities, which made it not available for disguised sale purposes. Some important temporary regulations under 707 were that all liabilities are allocated as Tier 3 non-recourse. And under 752, bottom dollar guarantees would be disregarded for disguised sale purposes. And then proposed regulations under 752, which gave rise to the newly formed anti-abuse rule for disregarded guarantees and other sorts of payment obligations. So to go into more detail, under the new 752 temporary regulations dealing with bottom dollar guarantees. For all purposes of Section 752, not just for disguised sale purposes, bottom dollar payment obligations will not be taken into account for determining whether a liability is recourse to a partner, with obvious certain exceptions. So the reasoning was that the IRS generally views such arrangements as lacking significant non-tax commercial business purposes. So then they defined any bottom dollar payment obligation as any payment obligation other than one in which the partner would be liable up to the full amount of such partner's payment obligation if and to the extent that any amount of the partnership liability is not otherwise satisfied. Disclosure is still required for all bottom dollar payment obligations that are incurred or modified after these regulations go into effect, and that includes obligations that are recognized under the 90% rule, which I'll discuss on this following slide. So these are some exceptions. An obligation that may not be treated as a bottom dollar payment obligation because there's a capped obligation. A maximum amount is placed on the obligation. Vertical slice guarantees will still be recognized, and certain rights of contribution, where there's a right of proportionate contribution running between co-guarantors with respect to a payment obligation for which each of them are both jointly and severally liable. There is the 90% rule, which says that a bottom dollar payment obligation would be still recognized if the partner remains liable for at least 90% of the partner's or a related person's initial payment obligation, even after taking into an account any indemnity or reimbursement agreement. So if you have an obligation and another partner can agree to indemnify you for less than 10% of that obligation, or up to 10% of that obligation, and you could still be recognized for the entire obligation. Lastly, the anti-abuse rule would allow the IRS to respect certain payment obligations that may otherwise be disregarded following these new rules if the obligation was structured purposefully to meet these rules, but it was to allow the related liability to be treated as non-recourse intentionally. So that's where the purpose would have been to have other partners included on the debt. The temporary regulations that I just discussed become effective immediately on October 4th of 2016 when they were released. However, pre-existing liabilities and ones that were already under contract before this date would not have to apply these new temporary regulations. There's also a 7-year transitional relief, which would the regulations for any partner with a negative tax capital account, to the extent that the account is negative as of October 5th, a partner may continue to apply the prior law to debts and payment obligations occurred even after October 4th, but only for 7 years afterwards. These temporary regulations would expire on October 4th of 2019 if they are not finalized before that date. Under 752, the new proposed regs, there's a general anti-abuse rule. And under the proposed regulations, even if an obligation passes the rules, it must also be tested under this general anti-abuse rule. So the new proposed regulations differ from the fairly harsh 2014 proposed regulations in that it's not an all or nothing test anymore. And instead, it created a non-exclusive list of 10 factors in the anti-abuse rule that can be weighed. Some of those factors are listed out here. The net value requirement was also replaced with a presumption which said that evidence of a plan to circumvent or avoid an obligation is deemed to exist if there's no reasonable expectation that the obligor will have the ability to satisfy the obligation. So those are just proposed regulations and a proposed anti-abuse rule. The new temporary regulations under 707 go on to say that all liabilities are treated as non-recourse for disguised sale purposes. So guarantees, even guarantees that would pass under the new 752 regulations can't be used to prevent a shift in liabilities for disguised sale purposes. So that would mean that an assumption of any non-qualified liability would cause the related contribution to be treated in part as a taxable disguised sale, because the contributing partner would have been responsible for that entire liability, and even if they guarantee that liability when they contribute the property, that liability is now treated as non-recourse, and some of that liability would be shifted to other partners. Similarly, a debt finance distribution that's in excess of any partner's pro rata share of the liability will trigger a partial sale if not otherwise exempt under the disguised sale rules. All liabilities are treated as non-recourse in accordance with Tier 3. Under the new final regulations, it's been amended to where Tier 3, you can no longer use the alternative method for allocating excess non-recourse liabilities. And also in these regulations, contributing partners' share of liabilities is reduced by any amount with respect to which any other partner has the risk of loss. So even though guarantees, which we mentioned, cannot help anymore in shifting liabilities, guarantees by the contributing partner can't help, guarantees by other partners can hurt. So the result of an attempted leverage partnership structure, which is the same basic example I gave under the previous regulations, but now applying the new temporary 707 regulations. An owner that contributes property with a basis of 0 and significant fair market value, in which the partnership then gets a loan based on that asset, and an owner that contributing partner would guarantee that loan. The $1,800 liability is treated as non-recourse. So for disguised sale purposes, it's allocated according to Tier 3 under 752. So you would have to know the percentage of ownership or the percentage of profits that this partner shares, and they would only get a portion of the new liability allocated to them based on their either ownership share of the partnership or percentage of profits from the partnership, not the fully guaranteed liability. The new temporary 707 regulations, they were delayed for 90 days, so they did not come into effect until January 3rd. So they were effective for any transaction with respect to which all transfers occur on or after January 3rd. Now, all transfers is key because if a partner had contributed property or had taken at least some sort of step before that date, then the subsequent transfer may have been grandfathered in and could be treated under the old regulations. However, even though the 707 new temporary regulations have this 90-day delay, the 752 temporary regulations were immediately effective, and any guarantee that was made on that first step would still have to pass a muster under the new 752 regulations, even if the transaction was grandfathered for 707 purposes. These temporary regulations have the same October 4th, 2019 expiration date, unless finalized regulations are made before then. So the final regulations under 707 also deal with disguised sale issues, but kind of some ancillary issues. So these deal with CapEx expenditure amendments, de minimis exception that would work to taint qualified liabilities, the step into the shoes rule for CapEx and qualified liabilities, and they created a new category of qualified liabilities. So when it comes to the CapEx rules, which was a big exception to the disguised sale rule, this rule would permit a contributing partner to receive distributions from the partnership in order to reimburse them for any capital expenditures that was made by the partner on any contributed property within 2 years of contributing that property to the partnership. So in general, the exception is available for expenditures only up to 20% of the value of the contributed property. However, the 20% limitation does not apply if the property's fair market value is less than 120% of its basis. So the 20% limitation is tested property by property. So under the final regulations, when multiple properties are contributed in any single transaction, the 20% CapEx limitation is based on each property, not the transaction as a whole. So you can't contribute properties that have a high fair market value that's over 120% of its basis, and also contribute properties that have a fair market value below its basis in order to get an average that's below the 20% rule, the 120% rule. So this could be favorable or unfavorable, and there is no guidance as to what constitutes property in the regulation. So I have a couple of examples here. One of the examples for the CapEx rule is if a partner owns two assets, asset one has a fair market value that's above its basis. Asset two has a fair market value that's even more above its basis. You wouldn't combine the fair market value of both properties and combine the basis of both properties in order to apply these rules. You would apply them separately. So asset one you would test separately and say it's not substantially appreciated because its fair market value is less than 120% of its basis. And asset two you would test separately, and it would end up being substantially appreciated because its fair market value is 120% or more of its basis. So in this example, it would be beneficial because that they're tested separately. Because here, since asset one is not substantially appreciated, the entire $200 may be reimbursed for that property, and the 20% rule doesn't apply. And asset two is substantially appreciated, so the 20% applies only to asset two, not asset one. So when they're tested separately, the total amount that would qualify under this regulation to be reimbursed is $240, but if you had to test them in the aggregate, the amount of $80 would only qualify under the regulation. So the next example too is kind of same fact pattern, but different values, which just goes to show that in some cases, being able to aggregate would provide more of a benefit than property by property result. But the rule is that you have to test each property on its own. The final 707 regulations, just real quick before we wrap up, also affected new tiered partnerships in saying that if a partner contributes property to which he's made capital expenditures to a lower tiered partnership and then contributes the lower tiered partnership interest to an upper tier partnership, the upper tier partnership steps into the shoes of the partner when it comes to those capital expenditures, and therefore that upper tier partnership can be reimbursed by the lower tier partnership, even though the upper tier partnership did not incur the capital expenditures itself. And in addition, a partner can look through an upper tier partnership with respect to the capital expenditures and therefore can be reimbursed by the upper tier partnership, even though the upper tier partnership doesn't own the contributed property, the lower tier partnership does. In addition, there's an overlap with qualified liabilities. One category of qualified liabilities is any liability that's incurred to make capital expenditures on the contributed property. That's in addition to the definition of what qualified liability is. And in addition, so prior to the issuance of these new regulations, there was this question as to the extent to which a partner could avoid gain on a shift in any capital expenditure liability and also receive cash reimbursements of those expenditures. And if so, would this represent a double counting of the expenditures? So the new regulations clarify that in this case, the capital expenditure exception applies to distributions only to the extent of the contributing partner's share of that qualified liability. You can't get both. When it comes to the de minimis exception to a qualified liability taint from non-qualified liabilities, if a contributing partner receives even $1 of disguised sale consideration, which could also be from a shift in non-qualified liabilities, a portion of any assumed qualified liabilities would also get tainted. So the exception to this rule under the new regulations is that qualified liabilities will not be tainted if the total amount of the non-qualified liabilities assumed by the partnership is the lesser of 10% of all qualified liabilities assumed by the partnership, or $1 million. So if you're working with big partnerships, because of the $1 million threshold, a lot of transactions will not benefit from this rule. However, if you're working with smaller businesses that are set up as a partnership, this may be an effective planning tool. So prior to these new regulations, it was unclear when and to what extent a transferee of property would step into the transferor's shoes when respect to the capex made by the transferor, and it was unclear whether a qualified liability retained its status as qualified when it's assumed by a transferee. So previous guidance pointed that it was limited only to 381 transactions and certain other limited situations. However, the new regulations clarify this and say that a transferee steps into the transferor's shoes both with respect to capex expenditures and qualified liabilities to the extent the property or liability was acquired or assumed in a non-recognition transaction under 721, 731, 351, and 381. So it's not just 381. The new qualified liability is the new class of qualified liability. It's a liability that was not incurred in anticipation of the transfer of the property to a partnership, but that was incurred in connection with the trade or business in which property transferred to the partnership was used or held, but only if all of the assets related to that trade or business are transferred, other than assets that are not material to a continuation of the trade or business. So if you have a trade or business that's operational and you happen to take out a new liability and subsequent to that, the partner, this company wants to contribute that property in whole to a partnership, other than certain assets that are not really material to the business and the combination of these two businesses, as long as it wasn't incurred in anticipation of the transfer, it can be classified as a qualified liability. So that is all that I have. If you do have any questions, I'm more than happy to do my best in answering them here on the phone. However, if it is more of a detailed question, I do have a longer article that I wrote for the Allman Year in Review in 2017 for this year, or I did put my email address there. You're more than welcome to reach out to me if you have any specific questions that I might be able to help answer for you.
And Collin, listeners may unmute themselves by pressing #6.
I don't know if everyone heard that, but if somebody has a question, I guess you can unmute yourself by pressing #6.
Very good presentation. Thank you.
Absolutely. Thank you.
Could you give us a course code?
I think the course code will be emailed to all of the registrants of the CLE course sometime after 1 o'clock.
Thank you. It was presented in a very understandable format and fashion.
Oh, thank you very much.
Okay, if there are no more questions, I believe that concludes today's CLE presentation.